Hey everyone, as I'm sure you've heard, the Fed has cut the interest rate to 0%. But what does this mean for the housing market? To be clear, this does not mean mortgage rates are 0%. However, mortgage rates generally increase and decrease with the Fed rate, so this usually means lower interest rates. This is the first time it's been this low since 2008. The stock market has taken quite a hit recently, but historically this doesn't always result in a downturn in the housing market. So the question is, do I buy now with low interest rates or try to bet on a downturn in the housing market? The main goal of this comparison is to show the impact an interest rate has on the long-term cost of owning a home. And to accomplish this, we're not just going to compare it to a house with a higher interest rate, but we're going to compare it to a house with a higher interest rate after a market crash. Let's say you're a first-time home buyer and you're going to buy a house right now for $320,000. In 2008, we experienced the largest downturn in modern history of the housing market, and houses dropped 20%. Odds of this level of drop happening again would be an anomaly, but let's go with it anyway. So instead, if we had a 20% drop on this $320,000 house, it would now be worth $256,000. Let's say you put 5% down on this home. That would be $16,000 or $12,800 respectively. If you can't afford a down payment, there are lots of other loan options like VA loans or down payment assistance that can help reduce or eliminate this down payment. Next, let's look at interest rate. And this is what we're really going to focus on. Let's say right now you can get an interest rate for 3.5%, which is very possible. Could be 3.75, could be 4, but somewhere in that range, especially if mortgage rates decrease, this is a very possible option for you. Now let's compare that to an interest rate of 5.5%. You may think that's crazy high right now, but 2 years ago, I personally locked in my home at 5.25%, so this is not uncommon. With the information we've just laid out, let's look at the two payments. We're just going to include principal and interest because taxes and insurance are going to adjust regardless. For the first house, $320,000 purchase price at 3.5% interest, your principal and interest is going to equal $1,365 a month. With the second option, with a purchase price of $256,000 and an interest rate of 5.5%, your payment, principal and interest, is going to be $1,381 a month. And if you didn't notice, that's actually higher than the other payment. Now that we've compared the payment of these two options, let's look at what the long-term cost of interest would be on each of them. On the $320,000 house, with 3.5% interest, over 30 years, you're going to pay a total interest of $187,000. Now, that may seem like a lot of interest, but on the $256,000 home at 5.5% interest, you're gonna end up paying over $253,000 of interest over the 30-year course of that loan. Let's look at the total cost of each of these loans. We're gonna do that by taking the home purchase price and adding the total interest to it. So with the first one, we're gonna take the purchase price of $320,000, add in the $187,000 to get a total cost of ownership of $507,000. With the second option, you have your purchase price of $256,000, add in the $253,000 of interest, and you end up with about $509,000 of total cost. As you can see, comparing these two options, they come out very similar, and actually you end up paying a little more on the one with the higher interest rate, even though you paid 20% less in purchase price. What I didn't even mention in these two end costs is that what are you doing in this meantime? In 2008, it took from 2008 to 2011 for us to reach the bottom of the market. In 2011 was the cheapest time to buy a home. That was 3 years. Now, it may not take that long, but maybe it's 2 years, maybe it's 1 year, if it downturns. We don't even know if it's gonna downturn. So, during these 1 to 2 years, what are you doing? You're probably renting. At rent for a $320,000 house, you're about $2,000 a month in today's market. Over the course of a 2-year period, at $2,000 a month, that's $48,000 you've paid in rent. And that's 2 years you could have been paying down your home. As you can see, now is a great time to buy because interest rates play a significant role in your home purchase and cost of ownership. In the second scenario, a 20% drop would be unlikely and unprecedented, and there's no guarantee of lower interest rates in the future. So if you're considering buying a home, now would be a great time to reach out to us. We'd be happy to look at your situation and get you on the path to home ownership.